Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullah. Now let's look at responsibility accounting and responsibility centers. So accumulating and reporting costs and revenue on basis of the managers who make decision about the item. So this one you are looking at how to report your cost and revenue. So the conditions, number one, cost and revenue can be directly associated with specific level of management responsibility, and then cost and revenues can be controlled. Okay, the keyword is controlled by employees at level of responsibility with which they are associated. And then budgeted data can be developed for evaluating the manager's effectiveness in controlling cost and revenue. Okay, so here if you can see at the departmental level. So for the department manager, I am responsible for controlling costs in my department. And then at the divisional manager, then I am responsible for controlling costs in my division. And at the company's level, so I'm responsible for controlling company costs. So you look at the responsibility at different level of management. And then what is responsibility center? So any individual who has control and is accountable for the activity. So when you talk about the responsibility accounting and you are looking at the responsibility center, is basically you are looking at the control. So may extend to any level of management, and normally it occurs in a decentralized organization. So you have a centralized organization, you have a decentralized organization. Normally if the company is small, then you will have a centralized organization. However, as the company grows bigger, so if you grow bigger and you tend to have many branches, for example, or many divisions or many segments, then you tend to have a decentralized organization. So when you have decentralization, then you tend to delegate the decision making authority. So when you delegate, then there comes in the responsibility. So this one is especially valuable in a decentralized organization or decentralized company. So control of operations delegated to many managers throughout the organization. So if let's say you have one company, you have many branches. So for each branch is considered as a decentralized organization. Okay, if let's say for an institution, for example, UITM. So at UITM, you have many branches. You have the HQ, you have the decentralized segment, you have the decentralized companies, or for UITM, for example, you have the branches, many branches, and that branch can be considered as a decentralization. Okay, so it will be headed by each rector, right? And then the control of operations delegated to many managers throughout the organization, or you can have segment. So you can segment your business into areas, for example, based on the geographical area. Okay, so maybe you have one in Johor, the other one is in Selangor, you have that one, another one in Terengganu or in Pahang. So you can segment your business based on the geographical area. Okay, or maybe area of responsibility for which reports are prepared. So that is basically when you look into the responsibility accounting. So two differences from budgeting in reporting cost and revenue. So when you look into the reporting of your cost and revenue in your budget, then you need to distinguish between controllable and the non-controllable cost. And then you emphasizes or includes only items that are controllable by that individual manager in the performance report. So because if that manager has no responsibility or no control over a certain cost, then you can't make him or her responsible for anything that associated with that particular item. Okay, for example, you have just take a simple example, like say you have a variable cost, you have a fixed cost. If that fixed cost is the item that is uncontrollable by that particular manager, then you can't blame for that particular manager if there were to be any increment or what anything that happens to that particular cost. Okay, and then this one, it also applies to profit as well as the non-profit entities. So if you have the profit entities, you know, of course, your objective will be to maximize your net income, or in other words, your net profit. So for profit making, for a profit oriented organization, so the bottom line is you want to have profit, you want to maximize your net profit or net income. But for the not for profit organization, then you will focusing on the minimizing the cost of providing that particular service. Okay, again, you look into the controllable versus the non-controllable. Look whether you are talking about the revenue or you are talking about the cost. So basically, controllable, a cost over which a manager has control, is called a controllable cost. So the issue here is whether you are able to control that particular cost or you don't have the control over that particular cost. So all costs are controllable by top management. Fewer costs are controllable as one moves down the each lower level of management responsibility. So costs incurred indirectly and allocated to a responsibility level are non-controllable. That means if let's say you are in a particular division and that particular division is being assigned a certain cost, so that cost is a non-controllable cost. It's being given, it's being directed, it's being allocated to that particular responsibility. Okay, just take this for example. If let's say you have this is the whole company, and then you have divisions. Okay, let's say this one is division A, division B, division C, and division D. So under this particular division, you will have various functional managers. So let's say this one, you have for that particular division, you have the cost, and that particular cost is, if let's say 4,000. Just take small figure. Let's say 4,000, and the cost here you give to R&D, you give to production, you give to marketing and sales, you give 1,000 each. So that means that is cost being allocated to all these four functional managers. So those costs are non-controllable costs, okay, that has been allocated by the division. So that is meant by that. So that is to say costs incurred indirectly and allocated to a responsibility level are non-controllable costs. If that cost the manager has a control, then that is called a controllable cost. So when you evaluate the performance, so management function that compares actual results with the budgeted goals, and that will include both behavioral and reporting principles. So have you heard about management by exception? So principles of performance evaluation is basically management by exception means that the top management's review of a budget report is focused primarily on differences between actual results and planned results. So you focus anything that is by exception. Only if that is exceptionally good or if that is exceptionally bad, then only you will focus your attention to that particular situation or that particular scenario. So if you look here, what is management by exception? So management by exception is the practice of examining the financial and operational results of a business. So you look at the results of your business, and you only bring issues to the attention of management if results represent substantial differences, okay, substantial differences from the budgeted or expected amount. So you have the budgeted figure and you have the actual results, and then you compare between your expected and your budgeted and your actual results. And if let's say, of course there will be variances, you won't get exactly the same as what you have budgeted, but what the things that you need to highlight only, for example, you go by exception. For example, the company controller may be required to notify management of those expenses that are greater of 10,000, okay, or 20% higher than expected. So you put a cut off there. you want, for example, if the difference is only like 1% or 2%, should you put your attention there? So it's just a waste of time maybe. So you just put your attention only for if there is exceptionally good or exceptionally bad. Or for example, you can say a cutoff of 20%. Also, any deviation by 20% or higher, then you will put your attention to that particular area. So that is basically what management by exception. So for management by exception, you will look into the materiality of that particular item. Materiality means basically the importance of that particular item. So without quantitative guidelines, management would have to investigate every budget difference regardless of the amount. So you focusing on the materiality only if that item is material of important, then only you put your attention to that particular area. And you also look at the controllability of the item. Exception guidelines are more restrictive for controllable items than for items the manager cannot control. So when you focus your attention, make sure that that particular item is within the control of that particular manager. So that is basically the principles of performance evaluation. You go by the exception. Okay, hopefully you have a better understanding on this. Okay, with that, I thank you.